Hi there, I'm Jeremy. If you're investing in Australia, here's one of the biggest questions you'll ever face. Should you invest personally or through a company? Whether it's shares, property, crypto, or even startups, where and how you hold your investments can make a massive difference in the tax you pay, the risk you carry, your flexibility over time, and how much wealth you keep when you sell. In this video, I'll break down the pros and cons of investing through a company versus investing personally. We'll use real tax comparisons, capital gains examples, dividend flows, and franking credits, long-term scenarios, and answers to common investor mistakes. This isn't generic financial advice. It's exactly the stuff your accountant wishes you asked about before tax season. Let's get into it. Part 1. How personal investment works. Most Australians invest in their own name. It's simple, automatic, and easy to track. You open a brokerage account, buy shares or property, and start earning income. But here's how tax works in that setup. All your investment income, whether it's dividends, rental income, or interest, is added to your personal taxable income. It stacks on top of your salary, freelance income, or business profits. If you're earning $100,000 from your job and your shares pay you $10,000 in dividends, your taxable income is now $110,000. You'll then pay tax at your marginal rate. That's 32.5% between $45,000 and $120,000, 37% up to $180,000, and 45% after that. Franking credits may reduce some of this, but not entirely. Now let's talk about capital gains. If you sell an asset after holding it for more than 12 months, you qualify for the 50% capital gains tax discount. So, if you bought $20,000 worth of shares and sold them for $40,000, your capital gain is $20,000. But you only pay tax on half of it. That's $10,000 added to your taxable income. In summary, personal investing is simple and comes with that valuable CGT discount. But once your income grows, it becomes less tax-friendly. Part 2. Investing through a company. Let's now talk about companies. When you invest through a company, you create a separate legal entity. That company owns the assets, not you. It has its own tax file number, Australian company number, and bank accounts. The company earns investment income, and it pays tax at a flat rate of 25%, provided it qualifies as a base rate entity. If the company earns $30,000 in dividends or sells shares for profit, it pays 25% company tax, regardless of your personal income. This is a huge advantage for high-income earners who want to reinvest profits, delay personal tax, or build a long-term investment structure. But there's a catch. Companies do not get the 50% capital gains tax discount. If a company makes a $100,000 capital gain, the full amount is taxed at 25%. No discounts apply. Also, if you want to withdraw profits from the company, you'll need to either pay yourself a salary or declare a dividend. Salaries are taxed in your personal name, and dividends are added to your income, although you may get franking credits to offset some of that tax. You're not avoiding tax, but you get more control over when and how you pay it. Part 3. Head-to-head comparison. Let's look at some real-world comparisons. First, a passive investor earning $10,000 in dividends. If you're investing in your personal name, that dividend income is added to your taxable income and taxed at your marginal rate. Franking credits can help, but you may still end up paying around $3,000 in tax if you're in the 30% bracket. If you invest through a company, the company pays 25% tax on that income, or $2,500. The difference is small, but the admin is much higher. Winner in this case? Probably personally. Now, let's say you make a capital gain of $100,000 from selling shares you held for more than a year. Personally, you get a 50% CGT discount. So, only $50,000 is added to your income. If you're in the 37% bracket, you'd pay around $18,500 in tax. Through a company, the full $100,000 is taxed at 25%. That's $25,000 in tax. In this case, personal investing gives you a lower tax bill. Part 4. When a company makes sense. So, when should you consider investing through a company? First, if you're earning over $150,000 annually. Second, if you want to reinvest profits instead of spending them. Third, if you're actively trading or running a business-like investment operation instead of receiving a passive income. Fourth, if you want asset protection or to separate risk. Fifth, if you're planning intergenerational wealth transfer or legacy planning. A company gives you the flexibility to time dividends, retain earnings, or use other advanced strategies. But for passive investors holding long-term shares or property, personal ownership still wins on simplicity and CGT benefits. Part 5. Advanced tax strategies. Let's go deeper with a few smart strategies. First, consider using a discretionary trust with a company as the trustee. This setup allows you to distribute income among family members while maintaining control. It's more complex, but can save serious tax if done properly. Second, split your investment types. Use personal ownership for long-term capital growth assets, like property or blue-chip stocks. Use a company for income-producing assets, like dividends, royalties, or licensing fees. Third, leave profits in the company to reinvest. If you don't need the income right away, don't draw it out. Keep it working for you inside the company and defer the personal tax. Fourth, understand franking credits. When your company pays tax and then distributes dividends, those dividends come with franking credits that reduce your personal tax bill. If your tax rate is the same or lower than the company's, you may owe very little additional tax. Part 6. Mistakes to avoid. Don't start a company just because it sounds impressive. If you're investing a few $1,000s into ETFs each month, the admin and accounting costs of a company will outweigh the benefits. Don't ignore the loss of the CGT discount. If you're planning to sell your investment property or shares in the next few years, and you're relying on that 50% discount, personal ownership may be better. Also, don't forget Division 7A. If you borrow money from your company without proper documentation or repayments, the ATO will treat it as a dividend and tax you heavily. Always use a tax professional when setting up structures like companies or trusts. It's not something to do casually, and mistakes can be expensive. Part 7. Recap and decision guide. Here's the quick recap. Invest in your personal name if you're a low to medium income earner. You want the 50% CGT discount. You're investing passively for long-term growth. You prefer simplicity and minimal admin. Invest through a company if you're a high-income earner. You want to retain and reinvest profits. You need tax flexibility and timing control. You're building a large or active investment portfolio. You want long-term asset protection and control. Remember, the best structure depends on your income, goals, and future plans. So, investing through a company or personally, which one is right for you? If you're just getting started or investing passively, personal ownership is probably all you need. But if you're earning a strong income, building a portfolio, and thinking long-term, a company structure might be the smarter move, especially when paired with expert tax advice. If this video helped, click the like button and subscribe for more financial and tax insights. Drop a comment below. Are you investing personally or through a company, and why? Thanks for watching, and I'll see you in the next one.